Well, how's it going, friends and family? My name is Zamos, and I gotta say this, okay? Sometimes a boring business model that prints cash, it might be better than investing into the AI bubble that we see here today. So, we're gonna be talking about Cal-Maine, and they're in the business of selling eggs. And I know, as soon as I said that sentence, I lost half of you. You might be like, why Cal-Maine? As you can see on your screen right now, if we zoom out for the past 365 days, the lowest price that they have achieved, I think it was back in March 13th. It was around like 80 bucks, 79.55. Right now, they're 84.94, and they're about to retest their one-year low. Now, here's the business case for Cal-Maine, okay? We're going to go more into depth later, but in the U.S., as it stands right now, the average person, including small people and big people and old people, the average person in the US will consume 300 eggs a year. Not only for breakfast, but the egg itself, it's an emulsifier for a lot of your favorite foods. A very integral ingredient for so many different recipes. And if you're on the fence on whether or not you want to keep watching, just take a look at your screen a little closer. Their PE ratio is a 3. Their dividend yield, they pay a qualified dividend payment, a 10.3%. They have a beautiful balance sheet, probably one of the best that I have seen in 2025. They have zero debt. No, I'm not exaggerating, zero debt on the books. They also have about $1 billion of cash on hand. Their ROIC, probably one of the best that I've seen in 2025. And depending on who you talk to, one can make the argument that Cal-Maine right now is undervalued. A PE of a 3. They're bouncing around their one-year low. So in this video, we're going to be exploring, analyzing, and taking a look at Cal-Maine to really see if they are a good hidden gem or if they're being priced correctly by the markets because they're a trash dumpster of a company. And in order to do that, we're going to be going over the recent developments that are surrounding the company. We're going to be calculating an inherent worth for their stock price based on their own numbers and data. And we're also going to be placing them on the compounder chart, which means we're going to be comparing them to all of the other companies that we have covered on the channel for the past 6 months. And then towards the end of the video, I'll be disclosing my game plan. Now, if that sounds good with you, let's go ahead and get into it. Let's talk a little more about what exactly is Cal-Maine, ticker symbol CALM, and how do they make money. So they operate in the commodity business, raising chickens and selling eggs. Super simple, okay? But it's worth calling out that they control the entire life cycle process. They raise the chickens, take care of the chickens, and each chicken, believe it or not, is on their balance sheet as an asset. And they own about 48 million egg-laying hens, which is kind of crazy to think about. And, well, I can't categorize them as a monopoly, but they do own about 17% of the egg market share in the US. And the crazy thing is, the next biggest player, well, they only have 7% of the egg market share, and that's Rose Acre Farms. And not too long ago, they actually acquired Echo Lake Foods. So now, not only are they selling eggs, but now they're also in the business of CPG food products that you'll see in the grocery aisles, which include ready-to-eat egg products, breakfast foods such as omelets, waffles, and pancakes. And their revenue breakdown for fiscal year 2025, for them right now, they're in 2026 because that's how their accounting calendar works. 67% of their revenue was derived from conventional eggs that you see when you go to the grocery store at Kroger's, Safeway, Costco, Walmart, 67%. 27% were from specialty eggs, such as like the cage-free eggs, the organic eggs, the free-range eggs. And then because of Echo Lake Foods, about 5% of their revenue was attributed towards the prepared CPG products. Now let's talk about what's happening with Cal-Maine as of recently. So they just posted their earnings, as you can see on your screen right now, October the 1st, 2025, first quarter 2026. It was just absolutely ridiculous across the board. Very, very positive. Net sales up 17.4%, eggshells up by 6%. Everything was up. Every single category, every single metric. And the biggest call out is probably their bottom line. It went up 33%. The diluted earnings per share, which is the profits per share, or otherwise known as the bottom line per share, it was up by 34% year over year. However, we do need to put these numbers into context. The numbers looked ridiculous because of the recent bird flu and all of the tailwinds that Cal-Maine had helping them out. Because of the bird flu, it caused a shortage of eggs from their competitors because their farms heavily impacted. Cal-Maine, on the other hand, not so much because their operational efficiency is pretty good. Yes, they did have bird flu outbreaks in the past, but in the most recent ones, it didn't really hurt them. And so it allowed their profits and their revenues to explode because they could charge the prices that they wanted since there was a supply demand. It's not like overnight America is going to stop using eggs, right? When you go to McDonald's and you order off of their breakfast menu, that requires eggs. When you go to Costco to order a sheet cake, that also requires eggs. Literally, America's economy would shut down if we stop using eggs overnight. And so you're going to do whatever it takes to pay those prices, especially if you're a business operation or an entity. At the individual level, yes, we can boycott the eggs, wait it out as the prices return. But for McDonald's, Costco, Safeway, Kroger's, they're going to have to buy the eggs at the price that Cal-Maine was selling it at. And the kick is, if they are impacted by the bird flu and they have to cull some of the birds, the government will reimburse them for that. So not only do they get the price gouge because there's a limited supply and inventory of eggs, but if they get rid of any of their birds, the government gives them a paycheck. So if you're wondering why their stock price went from $35 a share in July of 2021 to, I don't know, at their very high, August of 2025, what is that? $116 a share? It's because of the egg bubble. I know we talk about the AI bubble, but there was seriously an egg bubble happening in the US. I mean, what is that? That's a 228% return just based on the share price appreciation. Meaning, in a span of 4.5 years, you would have 3x your money with an egg business stock. It's pretty crazy to think about. So for my friends that are not based in the US, usually the cost for a dozen eggs, excluding New York, Alaska, Hawaii, and maybe California, usually around $3 for 12 eggs. However, whenever there's a catastrophic event like the bird flu that seems to happen every 2 to 3 years, they can charge up to like $8 a dozen. Now, what you want to keep in mind is when you think about their operations, it all remains the same, right? So their margins go through the roof. Their profits just explode because the only thing that really changes is the price tag that's on the eggs in the grocery store. Now, obviously, we can get into whether or not that's fair because I think that argument is valid, right? For companies to be able to do that in times of need or when there's a supply shortage. However, it is worth noting that the earnings call did hint at the fact that their numbers are going to decrease soon enough, meaning their margins are going to come back down to earth and the amount of profits that they're making, yeah, it might be temporary as we know it. Because the egg market, it's returning back to normal. And that's why in the past 2, 3, 4 months, their stock price is just getting hammered. So if you're wondering what's happening, hopefully that makes sense. So when you take into account the price of eggs in the US, it reached a peak back in February of about like $7.50 for a dozen. Can you believe that? It is absolutely crazy. However, what's been happening since then, now that our supply shortage is now evened out, because the US, we've been importing eggs from Brazil, Korea, China, and other countries. Now there's an adequate supply of eggs, even though we don't have the same amount of egg-laying hens. Look at the price of a dozen eggs just dropping. This is on the trading economics, commodity prices of eggs. You could also look at the crude oil prices, natural gas, gold, silver. Believe it or not, eggs, it's a commodity. Okay, so Cal-Maine, they're in a commodity business, which tends to be cyclical. And the price of a dozen eggs, I think it reached a low back in October 10th for a dozen, the wholesale price. Now it's slowly going back up and it's roughly, what would you say, about $2.16? Well, that's quite the drop. And I think that's another reason as to why their stock price is just getting shattered. because their profit margins are going to be decreased. The amount of sales that they're making per egg is also going to drop by a lot. It's dropping by roughly 60 to 70% depending on what the price stabilizes at. It looks like it's making a short little rebound, but roughly $2 to $3 is what it usually is for a dozen eggs. So all that to say, the numbers on the commodity side of the house, not looking too good for cow Maine. And I wanted to circle back about the ethics and the whole idea of price gouging. Do you remember during the pandemic when there was a toilet paper shortage? Dude, there were some jerk-offs that were going to Costco and buying up all of the toilet paper on the shelves and then reselling it on eBay and Amazon at 10 times the price. Personally, that ticks me off. That just shoves this Nalgene, this hydro flask right up my booty hole. That makes me so angry that there's people that operate with that type of greed in mind. So instead of buying 24 toilet paper rolls for $15, these dudes were selling it at 50, 60, 70 bucks and taking advantage of the situation. And it's just but all that to say, if you're feeling angry towards cow Maine for price gouging during the bird flu and egg bubble, well, fact of the matter is they're under investigation right now from the Department of Justice. And they're also facing lawsuits left and right for market manipulation for charging sky-high prices during that fiasco. And that's another reason as to why their stock price is selling off. What they own, that treasure egg, the valuation of it is dropping, but they're also getting regulatory probing. And because they're a commodity, there's market cycles. They're now going into the valley, their bear market for the egg market, if that makes sense. Okay, so now that we understand that their margins and profitability is going to be dramatically decreased quarter after quarter going forward, at least for the next year to 2 years, now let's go ahead and calculate an intrinsic valuation for cow Maine. When I think about it, the free cash flow, it makes no sense, right? Because it fluctuates depending on the market cycle. The dividend discount model also makes no sense because cow Maine is a dividend cutter. When the times are good, the dividend goes to the moon. When the times are bad, there's no hesitation for them to cut the dividend. The multiples valuation, I don't really like because their only true competitor that's publicly listed as a stock is Vital Farms, and they sell premium eggs. So an entirely different competitor. So I think the only thing that makes sense is going to be predicated upon their bottom line per share, the earnings. So in Q1 of 2026, that earnings that we just took a look at, October the 1st, they posted $4.12. I'm projecting that their net income per share is only going to get smaller and smaller as we go forward in 2026 for them, their accounting fiscal year. So Q2, I'm proposing $3.50, Q3, $1.75, and then to round it out for 2026, I'm thinking $1 of profits per share. Now, on paper, their PE is a 3, but if we apply their earnings per share for 2026 of about $10.37, and we divide it by their current trading price, $85, then their PE, their realistic PE is 8.2. And that's still pretty low, but it's a lot higher than the 3 that we see. So if they do finish out the year, according to their calendar, the next 9 months, $10.37 of profits per share, I'm thinking that their PE ratio, I think at a 3 or even at an 8, it's too low. But I think somewhere around a 10, I think that would make sense. Because as of right now, at the time of making this video, their forward trading multiple is 11. So I think even though Wall Street, hedge funds, and investors are feeling bearish towards cow Maine, I think somewhere around a 10 or 11 is not too crazy. I think a 3, a 4, or 5, I think that's too low. So if they hit a PE of a 10, I think in 2026, they'll be $103 a share. Right now, they're $85, so the upside, not too bad. And best case scenario, historically, for the past 20 years, their PE ratio on average is a 20.7. So even according to their own history, they're quote unquote undervalued, right? So if they hit a 20 PE, then they could hit a price of $214. Do I see that happening? Realistically, no. However, for whatever reason, if Wall Street just feels really, really bearish about Cal-Maine because of the regulatory probing, and there's another factor that we need to talk about, some other setbacks and costs I'll cover in the compounder chart segment. Let's just go ahead and assume that their PE is going to get shattered because this other setback is huge, okay? So let's say their PE, even though right now it's like a 3.5, let's say they maintain that PE. Look what happens to their share price if they execute on $10.37 of profits per share. $36.30. Dude, that would be a huge blow and a fall from grace from where they are right now at $85. Do I see that happening? Realistically, yeah, I can see that happening, but probability-wise, not likely. Maybe like a low single-digit percentage chance of that happening. Dude, I'm just spitballing numbers here. I can't tell the future. I'm not even going to pretend like I can, okay? I can't even predict when my daughter is about to have a blowout or spit up on me. Okay, you might think she's all good, and then you go... So I'm going to go ahead and assume a 10. Now, if we continue to play this game and we go into next year, I want to explain myself as to why I'm expecting their EPS to drop by 60%. So I'm projecting their EPS going from $10.37 down to $4.15. Reason being is that their 2022 EPS was $2.72. And that's prior to all of the tailwinds that made their profits explode. I think right now their EPS is like $25-26. We'll be taking a closer look at their numbers here in a little bit. But it's just going to get smaller and smaller because the landscape of the egg market went from their highs and now they're going back down to their lows. So I think, realistically, I think their PE is going to recover a little bit. If you were to ask me, I genuinely do not think their PE is going to be a 3 in 2027, which is a year and a half from now. I think somewhere around a 14 would be more probable, which means their stock price could be $58. And I hear you, they're 85. So according to 2027, EPS $4.15, they're overvalued. $58. But if they do reach their historic trading multiple of a 20.7, then as of right now, they're trading for a pretty fair valuation. $85 is what they should be at a year and a half from now, which means your money would be flat, stagnant, dead water, or basically rowing upstream. You're not going to get anywhere. But I think because Cal-Maine's leadership team, they're starting to behave and act more strategically on how to diversify their revenue streams instead of just being in the commodity eggs business. They just bought out Echo Lake Foods, right? So they're also trying to become like a General Mills, diversify their product offerings so that their revenue is more stabilized. So I'm thinking in 2028, I think all of that M&A that they're doing, the mergers and acquisitions, I think that's going to pay off. So I think their EPS will bounce 5% into the green, and it'll go from $4.15 to $4.36. And I think their PE is going to recover, going from a 3 as it is right now. Realistically, it's an 8, but whatever, to a 15. And if they achieve a 15, then their stock price could hit 65. If they go back up to their historic 20, then a 90. So the upside from $85 of what it is today to get to $90, yeah, it'll go up by $5, but not the greatest upside, right? And it's really hard to guesstimate what's going to happen to a commodity business because the market cycles are very volatile. Sometimes the bull markets can last a lot longer than you might anticipate. Sometimes you could have a bird flu, a black swan event, just smack you right out of the blue. But I'm assuming if everything just stabilizes and goes well and there's no more tailwinds or headwinds and they just operate as is, okay? In 2029, I think $4.57 for the EPS, not too crazy. And if they execute a PE of an 18, then they should be $82, which is a downside of about $3 from where they are right now. Or if they go back to their historic PE, a 20, then they could be $94. Now, something that I want to talk about before we pivot on over to the compounder chart is, you notice how their EPS is going from like $25 down to like $10, down to $4. Something that you want to keep in mind is that their dividend is contingent upon their earnings, which go up and down depending on the market cycle of egg prices and the food that the chickens eat. When we think about grains, soy, corn, they're all commodities. So they're dependent on one another, and depending on the cycle, things could be bad or good. And what I want to call out is that when the earnings go down, their dividend gets cut without any hesitation. Going from 2016 to right there, it got cut. It got cut again going from 2018 to 2019. It got cut during the pandemic. I don't even think they paid a dividend altogether in 2020. It skips from 2019 to 2021. And then, of course, when the bird flu event happened, their profits just went through the roof, and it resulted in a magnificent dividend. But then when they ran into some headwinds, they cut the dividend without any hesitation. And history tends to repeat itself when it comes to a dividend cutter. So right now, it looks like they're free falling, and that's because their earnings are also going to be dramatically reduced in the next few quarters or few years to come. And that's why if you only look at the surface numbers of like a 10% dividend yield, payout ratio being 33%, dividend growth rate being 200%, you might be like, dude, sign me up. But you have to read between the lines. It's not as good as it looks. Their dividend per share is $8.36, and projected upon next year being $10.30-something cents, their payout ratio is going to be closer to an 80%. And it's probably going to get cut. So unlike other, or I guess most companies, their dividend is like a slow and steady, predictable growth and a path and a trajectory. With Cal-Maine, it's up and down, right? So in the case of Cal-Maine, where would I place them when it comes to the compounded chart? All the way to the left, S tier, Google and Amazon. My money invested into either one of them is going to compound 5, 10, 15 years from now because their business model so amazing and immaculate. You get somewhere in the middle, C tier. These are average companies. Their fundamentals and financials looks really freaking phenomenal. Duolingo, Sezzle, Lululemon, PayPal. Look up any one of them. Their numbers are spectacular. However, the markets, they don't agree. They don't really like these companies. So that's why I have them as a C tier. And then the companies that are all the way to the right, F tier, obviously they're in the bubble labeled Kager Graveyard, meaning my money invested into them, not the wisest use of capital, right? Because why invest into Carter's or Chime Finance when I could invest into Meta, Google, or Amazon? So when it comes to Cal-Maine, history tends to repeat itself. It really does. Past performance is not indicative of future gains, but when it comes to commodities like oil and gas, the travel industry such as hotels, or in this case, commodities like eggs, up and down, right? And the stock price tends to follow. It's not like a Google, Amazon, Meta, Waste Connections. It's not like that, where it's like slow and steady and just growing. So Cal-Maine for me, I'm going to put them into the Kager Graveyard as a D+. The exact same way that I view Ford Motors or Big Bear AI. And the reason being is that, dude, the egg market, it's contingent upon the commodity prices of grain, soybean, and corn. And like if that market goes to the moon, then their operational cost to feed their chickens, their EPS is going to drop from that. Or if they have a bird flu event. But more importantly, I don't like the inconsistency of their dividend profile. And here's the biggest issue that I didn't want to talk about earlier, but it's this. When you think about chickens and the egg business, their living conditions are not so good, okay? You could pause this video, look it up on YouTube, Instagram, or whatever. It's kind of horrific to see, all right? I'm not a vegan. I'm a meat-eating guy, but the living conditions for the chickens, it's kind of sad. So, having said that, a lot of the states in the US, they're banning cages for egg-laying hens. Because as of right now, a chicken whose life purpose is to lay eggs, they'll live their entire life in a space about the size of like this. That's it. They don't even have room to jump or run. They're just all like sardines in a can. And it's kind of sad, okay? So the states are banning chickens being placed into cages for a better quality of life for the chickens. One could agree or disagree. Me, I think that's a good thing. Even though I'm a meat-eating guy, I think if we can treat the animals with a little more kindness, especially knowing that we're going to eat them, or their eggs in this case, right? I feel like we should do that if we have the capacity to do so. And as of right now, I think there's only like 13 or 15 states that are mandating this, but eventually I think it's going to be nationwide, except like Arkansas or maybe like Alabama, Missouri, Mississippi, maybe except those areas, but I think everywhere else is going to adopt this policy. So I did some research, and this is where it gets kind of crazy, okay? The cost to go from caged to cage-free is about $45 to $55 per bird. Now, if you remember, they have about 48 million egg-laying hens. Now, if that number stays consistent, that means for the next 10 to 20 years, that's going to cost $1.3 to $2.2 billion in capital expenditures in order to make those changes. As of right now, their CapEx, at the time of making this video, it's like $200 million. But can you imagine a $1.3 or $2.2 billion CapEx smack right to the left testicle? Yeah, that's going to further make their EPS drop, right? And their free cash flow drop, more importantly. So when I think about Cal-Maine, it kind of reminds me of Portland General Electric. It's a utility company that I was eyeballing for the longest time, and I was trying to buy into them at $38 a share. I think it bounced down to like $38.03 or $38.05, and I wasn't able to scoop them up. And they also were mandated by the jurisdictions that they operate in to provide electricity and power to make all of their equipment fireproof. That's a lot of CapEx, and that's why Portland General Electric, their stock price got hammered, even though their numbers looked spectacular, just like Cal-Maine. When you think about the future mandates in order to change their facilities and their farms and everything, that's a lot of money. So, having said that, now let's take a closer look at their numbers, and I'll be going over my game plan, and we can multitask. And before we hop on over to their financial statements, I wanted to circle back to their dividend profile. For me, right, I'm not trying to tell anyone else what to do with their money, but for me, it's like, yeah, I see that they have a very juicy dividend yield that's qualified, meaning it's going to be taxed at the capital gains rate of 0, 15, or 20% for us Americans. But what good is it to buy into this, to get it like one time, knowing that this dividend is going to be cut? Because the proof is in the pudding. Right now, they're in their downward spiral, and it's going to drop all the way down to potentially 0 cents of dividends per share. Because when you think about it, man, a dividend compounder, they have their numbers growing each year, especially for the dividend profile. They're reliable, consistent, and it's not cyclical. But in the case of Cal-Maine, take a look at their revenue situation, right? It's up and down, up and down, up and down. And right now it's up. And I'm not trying to say that history repeats itself, but what's next, based on what's happening in the egg market industry, it's about to drop. And it's about to drop pretty darn hard, right? The bird flu epidemic and all that stuff, it's gone. If you go to the grocery store right now, egg prices, it's no longer $8, $11, or $14 a dozen. Now they're back down to what they usually are. But having said that, I will give them props. When the times are good, they're able to execute a beautiful profits per share. I mean, right now it's $26 of profits per share, but based on my forecast and model, I do think it's going to drop. And see right here, fiscal year 2022, prior to the bird flu and all of their profits going through the roof, it was $2.72. And that's why I think they're going to pick it back up somewhere around $4 to $5, because they no longer have tailwinds, but they also have regulatory setbacks and court settlement fees. And I'm baking that in, okay? Jump on over to their balance sheet. This is where I will give them some brownie points. They have $1.2 billion of cash on hand. That's pretty spectacular. But what makes that even more significant is that when you take a look at their debt right here, total debt, the last time that they had debt was 2021 of $2 million. Since then, they've had no loans or debt obligations on the books. That's phenomenal. So for me, I do have to give them some brownie points back, because usually corporations, they carry some debt year over year because you got to borrow money in order to make money, right? As they say. But in the case for Cal-Maine, I think that's really impressive. So their net cash to debt ratio is a 1.2 billion. They have no debt on the books. And if we take a look at their free cash flow, right now it's $24.92 of free cash flow per share. Unfortunately, I do see it dropping off a cliff, because think about the CapEx in order to go cage-free. Think about their court cases. And with the integration of their CPG business segment of selling pre-made pancakes or egg batter or what have you, that's also going to eat into their free cash flow. So having said all of that, I think Cal-Maine, it's what I said in the compounder chart. I think they're okay. It really depends on when you buy into them. If you buy into them at their very top, at their market cycle, you're going to have a bad time for the next, 6, 7. It took about 7 years for you to break even if you bought into them during their highs of 2015. Likewise, if you buy into it right now at like 115 a share, 120 a share, or 85 a share, who's to say that it's not going to take another 5, 7, or 10 years to just break even? And during that time span, your dividend's going to get cut. So you're going to be holding on to something that's going to be deep into the red, and it's going to be an eyesore to see it in your portfolio day after day, right? That's what I'm thinking. And right now, just as a reminder, their numbers, it's growing at a very absolutely ridiculous rate because of the bird flu. Their numbers are inflated because of the ripple effects from the avian flu outbreaks. At the end of the day, it's still a cyclical commodity. I try not to invest into cyclical stocks. I learned my lesson the hard way. And do they have an economic moat? I don't think they have an economic moat. Yes, they're the biggest egg player in the US, but at 17% of the market share, it would be better if they had like 40, 50, 60% of the market share. Then I'd be like, you know what? I think it's an oligopoly. But at 17%, I'm like, And if you understand the numbers, they look cheap right now, PE ratio of 3, because they just had tailwinds making them soar on their backs, right? The wind is helping them sail in the seas. So understanding the market cycles of the egg commodity sector, I'm just not feeling that fuzzy feeling in my stomach that tells me to pee in the dark or to try a ghost pepper hot sauce with my breakfast. I'm just not feeling it. So I'm gonna have to pass on Cal-Maine. And when I think about the regulatory probing for the ridiculous price gouging that they participated in 2022 all the way up to recently, yeah, who knows how hefty of a penalty they're going to be slapped with, right? It might not be a slap on the wrist. So, as they say, just be careful betting too heavily on a setup like this. I think this is a value trap. I think on the surface level, things look really promising and really good. But who's to say it's not going to go down to 50 or even 40 or even $34 a share, right? Or I guess this is a perfect time for me to say a dad joke now that I am a dad. I want to be careful putting all of my eggs into this basket, because this basket, it looks a little rocky. I think there's better opportunities in the market. These are some of the stocks that I've been dollar cost averaging into as the market has been red day after day for the past week and a half. Clorox, Procter & Gamble, United Health, Realty Income, Waste Connections, Lockheed Martin, or even Salesforce. I'm not trying to tell you what to do with your money. It's just what I've been doing. I think those are better opportunities than Cal-Maine. And I know that Cal-Maine has a PE of 3. But having said that, because now that I spent so much time understanding this company, I think if they do drop down to 40 or $30, I might entertain the idea of jumping in. If there's no other setbacks and they're just getting sold off because of everything that we talked about today. However, if there's another catalyst that's really negative and that's why they're selling off, then obviously I'm not going to jump in. Reason being is, historically, after their market lows, they do tend to recover. And when they recover, you're going to get a very fat dividend paycheck with it. And then for me, I would love to sell once they reach their market highs. I think to buy into it as they're on the downward trend of their market high, you know what, like in a roller coaster, you get to the top and it's about to drop. To buy into it as it's about to drop, for me, I just don't think that's too wise. And I'm not trying to throw shade or make fun of you if you're buying into it. It's just what I think. And I'm an idiot. I could be wrong. But I do think the roller coaster ride is about to drop hard and fast. So I'm going to pass. Having said that, what do you think? Do you like Cal Maine? Do you agree with what I said? Am I an idiot? Let me know. Having said that, I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time. Peace.